afterwards, feel free to step in. Over the last several years, there have been an explosion of papers that rely on the usage of different machine learning techniques in all sorts of applications in finance. And in particular, in empirical asset pricing, the focus was on forecasting returns. So we have papers that looked at forecasting the market risk premium with a bunch of predictors and different tools, term structure of interest rates, stocks, of course, as functions of their characteristics, and those characteristics could be either numerical or they could be text-based. And recently, there also have been more and more work thinking about the cross-predictability of returns in different asset classes. For example, the information linkages between stocks and corporate bonds. What type of characteristics are driving what, and how we can improve the performance of some of the standard models and results we have seen so far. And if there is one thing that all of these papers they sort of agree upon, is that machine learning tools provide a very powerful and flexible way of describing things which are normally quite difficult to model. They are more robust, they work out of samples, they uncover important nonlinearities, which are important not just statistically but economically as well, and they can pave a way towards much better, more, albeit complicated, but also at the same time much more encompassing understanding of what exactly drives the cross-section of asset returns in terms of both the dimensionality of the problem and also the channels. Because one of the most important conceptually questions that have been tackled in this type of literature is the debate on what exactly are the sort of news that are going to be about discount rate versus the cash flow channels of predictability. And again, machine learning tools have been very successful in trying to tackle that as well. So the two papers that we're going to hear today about are all about one particular aspect of that predictability, which is a direct focus on the cash flow channel, the forecasting of earnings, and in particular, whether we can do better than the standard linear models of the forecasting for producing the expectations of the next year or the 2 years ahead earnings for a cross-section of firms, and whether human analysts, biased as they are, concerned with a lot of the other issues on top of just producing the best forecast possible, is there scope for a human in this type of exercise, and what can we learn about the behavior of agents from this type of exercise? And this is why the two papers that we're going to be hearing today, they very nicely complement each other. One is basically focusing on the superiority and the skill of the machine learning tools in picking up predictability patterns that would otherwise have been missed using the standard simple models. And while the other touches upon something even more interesting, what's the role of a person there? And if I were to kind of briefly try to summarize the findings in each of the papers and what they're really about, they probably would have been summarized as follows. So the first paper takes the standard off-the-shelf machine learning tools, starting from something very simple like ridge regression and lasso, which have been already used in a whole number of applications, and going towards random forest and neural networks, much more suitable for usual machine learning techniques, to forecast earnings for a wide range of CompuStat firms. The main focus on 1 year forward forecasts. And in short, the authors find out that the machine learning tools, they perform substantially better than the standard approaches in forecasting earnings of these companies. Importantly, they do so by allowing a very flexible form of nonlinearities. And when I say that they're performing better, it is important to note that it's not just a statistical measure like mean squared error or something like this, but it also has important implications for cross-sectional asset pricing. There is a certain types of firms for which there is going to be a sizable improvement in this forecast. And that is also going to be manifesting in the expected returns going forward. So this is not just about an average quality of the forecast, but this is about cross-sectional features of the forecast that are coming into play. And this is why this type of analysis generates, of course, a cross-sectional spread in the future returns on those securities. The second paper, the term structure of expectation and biases, uses one particular tool from the machine learning literature, random forest, to encompass information contained in economic fundamentals of the firms, macroeconomic predictors, as well as analyst forecasts to predict the earnings of companies going forward. And they consider not just one horizon for predictability, but several, ranging from 1 quarter to 2 year ahead forecast, from where the term structure of expectation and biases forms. These output from the random forest is then essentially labeled as the unbiased, objective, statistically optimal prediction of the earnings of these firms. And we can compare what the analysts have been saying about the firms relative to the objective forecast produced by the machines. This creates the term structure of expectation and biases of those analysts. Now, obviously, analysts turn out to be substantially biased. That said, they do revise their expectation towards the announcement dates. This also has a range of implications cross-sectional, both from the financial investment side and on the real side of the economy. In particular, the short legs of many anomalies, they're going to be really concentrated among the firms that have excessively optimistic forecasts. And there is some empirical evidence suggesting that there is, I don't want to say causal, but there is a certain link between those companies being excessively lauded as kind of future winners and companies that are going to be performing really well going forward relative to their expected returns and the concentration of the alpha in a whole range of prominent anomalies. On the real side, those companies that have been also the object of this excessive optimism from the analyst, they also tend to make use of this biased information and they issue additional shares. Okay. The other interesting part of the second paper is that analyst forecast, albeit being biased, and again, we didn't really need machine learning tools to know that this is something that has been established from the previous literature as well, but they are an important contribution to the unbiased best forecast for the earnings of the companies going forward. And this is also going to be one of the issues that we're going to be talking about later, which is what is the role of the human analyst? When or why we could say that a human analyst can improve upon the automatic contribution from the machine. So, speaking about random forest and speaking about machine learning in general, the thing that I want you guys to keep in mind is the picture that I borrowed from the 10 years challenge that was quite popular on Facebook a few years ago. In other words, no matter what we call today as machine learning tools, the majority of them are really standard statistical techniques that we have been using in many different contexts for literally years and years, if not decades. So there is nothing, fundamentally conceptually weird or, unknown or complicated about the majority of the machine learning tools. And most of the time, they just present a slight generalization of our linear regression. They're going to be non-parametric approaches to their estimation, and that's why they're going to be so flexible in encompassing information from different predictors. But I do find out that these two papers, they very nicely complement each other in terms of thinking about the sources and the nature of the predictability. And my comments overall on the discussion are going to be really focusing on the setup of the problem, on the nature of the particular tools and whether they are appropriate for this type of question, and also for the interpretation of the findings and how to go forward in this type of literature. So first of all, just a quick recap for the non-parametric estimation. Non-parametric estimation used in machine learning and in standard non-parametric regressions is absolutely standard tool that we have been using for decades. And the simplest example of it are portfolio sorts. Every time we use single or double sorting, we are essentially using a non-parametric estimator for expected return, where we're saying that the return on the security is essentially equal to the average return on the whole bucket that contains this stock and others similar to it. So it is already a non-parametric estimator of the sorts. But then you could say that, okay, we are assigning the same number to all the stocks that are belonging to a particular decile or a bucket, but some securities are closer to the middle. Others are going to be closer to a different decile. Probably we should take into account that distance towards similar securities. And this is what kernel, sieve, and other standard tools from the machine learning are about. It's all about trying to understand what are going to be the right neighbors of our companies, so that we can average the prediction based on the information from those neighbors. And the measure of distance is the functional form of that distance is precisely what distinguishes portfolio sorts from kernel regressions, from a random forest, and from everything else. But the idea behind this is exactly the same as our standard portfolio sorts: averaging, bundling across similar objects. Random forest is the tool that has been used, among other things, by both papers, and this is why this is the stuff that I want to briefly recap for those of you who may not be familiar with these techniques. Random forest is based on a very simple idea. Suppose that we have a whole bunch of different predictors, X, and we want to forecast Y. How do we figure out what are going to be the neighbors, what are going to be the similar objects for us to average the prediction on? We could create a random subset of predictors, for example, variable number 1, 2, and 3, and split the data based on the value of those predictors. Think about it as characteristics, using just size and, for example, accruals, or maybe book to market and, liquidity in order to create corresponding portfolio sorts. Depending on the value of those characteristics, depending on the deciles, we are going to be going down the tree and end up with a corresponding bucket of similar securities that are also high in terms of characteristic 1, low in characteristic 2, and so on and so forth. So we are going to be then averaging the return on each of those stocks, maybe the earnings of each of those companies, depending on the underlying characteristic of those business. The important thing here is that every such tree, every such conditional sort, is going to be producing a biased estimate. But since at any given point of time, the type of characteristics that go into creation of this tree is going to be random, those biases are going to be washing out when we're going to be looking at the average across the output of each of those decision trees. Another thing that makes the random forest such a powerful tool is that the split, which is done at every part of that node, is going to be optimal. That is, we're not going to be saying that we always do like 50-50 split or 10-90 split, depending on the value of the underlying variable, but we're going to ask a question, where exactly should we do in this particular split so that it leads to the optimal path going forward. And that's the idea behind the random forest. Now, what do we know about the properties of random forest, seeing that it empirically performs so well in a whole range of different contexts? Every time you see a recommendation of what else to watch on Netflix, you're actually looking at the output of random forest as well. And this is where I want to disagree with the statements which are made in the second paper, which 15 times throughout the whole paper is making a claim that the output of the random forest forecast is going to be statistically optimal and it is going to be unbiased. And the reason is because while indeed averaging across the biased predictors should produce something that is unbiased or asymptotically unbiased, this is not a statement that can be taken lightly. And of course, like any other non-parametric estimator, it has its own properties that has been established in a whole range of statistical literature, especially in the last 5-7 years. And when we're talking about a particular non-parametric estimator being statistically optimal, that should actually imply a very specific notion. Usually when we say something about optimality of the forecast, optimality of a machine learning or linear regression tool, what we have in mind is that this is the approach that generates an estimator with the smallest variance among a certain class of estimators. Like OLS produces the best forecast under certain conditions in the class of linear unbiased estimators. This class of estimators is not defined in the paper. And to the best of my knowledge, there are also no results in the literature overall that would claim that a random forest is optimal under, a certain family of non-parametric estimators. In fact, one of the features of the non-parametric estimators overall is that no matter how flexible they are, there is usually a whole family of them that all achieve the same efficiency bound. So think about using neural networks versus random forest versus some other way of non-parametric estimation. They should all achieve more or less the same thing. To give a simple example, compare standard non-parametric regressions with sieves versus kernels. There is no way to pick what one is better than the other. They all have the same rates. What do we know? What do we know about random forest? We do know that it is asymptotically unbiased. We know that there are some conditions under which it is consistent, and there is a convergence rate results and the whole procedure that goes along with it. We know that the output of the procedure is asymptotically normal, and we also know how to compute standard errors for the outcome of random forest. We also know how to find the asymptotic distribution and as a result the confidence intervals for the forecasts of the random forest. This means that my first advice to both papers is going to be not to just look at the mean squared error of the pointwise prediction, but if you are using tools which are developed with the machine learning techniques, then you should also be relying on all the inference machinery that comes along with it. After all, if we are running linear regressions, we have t-statistics, we have p-values. Everything else have been developed as well for most of the machine learning tools, and I think we should definitely base on it. So this way, I think when we are talking about the economic and significance predictions and the new stuff that these tools are bringing to the table, I think we should definitely rely on them in the first place. Part of the outcome of the random forest tool and stuff that it shares with the standard sorting, like conditional sorts, is the fact that the prediction is just a simple average. But when we're thinking about the forecasts and how agents compute those forecasts, whether it's something better than the model, usually we don't have in mind a simple piecewise linear model. What we have in mind are predictors, the impact of predictors, be it the past, profitability of the company, be it the business cycle of the company, be it some other accounting information that we're observing on the balance sheet. And this means that probably a more robust way, a more interpretable and economically plausible way to think about predictability here would be the so-called macro random forest that explicitly allows you to model predictability as being a function of a bunch of variables, not just whether something is high or low, but whether something that can be linear. And the generalization of this linear regression here is not only very easy to do, but it's also super flexible, because it will allow you to establish the direct comparison with the standard linear regression model. It will also allow you to think about regime switching, structural breaks, smooth transitions in the parameters, all those non-linearities that we do know how to interpret well. And this is why I think that, at least as a robustness check, this is definitely something that I would recommend both papers to look at. Otherwise, it's going to be really hard to compare the outcome of different models. When we're dealing with predictability, so we're dealing with stocks, or when we're dealing with earnings of the companies, one benefit that machine learning tools bring to the table is that they allow you to handle so many variables at the same time. And this is undoubtedly going to be the major strength of this approach. And one of the major sources of this predictability variables was different ratios and accounting information of the firms. The more predictors we're using that are based on the firm level information, the more unbalanced it becomes. And this is actually a major limitation for a lot of these methods. But it's the sort of limitation that is usually swiped under the cover, because most of the time, whenever we are dealing with something missing, like some ratios are missing, what all the papers in machine learning and normal regression approach have been doing, they would just impute it with zeros, cross-sectional average of a given missing characteristic. This is wrong. And this is fundamentally wrong because the majority of the information that is useful for the prediction of earnings, of course, is going to be related to the balance sheet. Of course, it's going to be related to a lot of the fundamentals of the companies, and they're going to be correlated with each other. So if you have a set of 60 variables, some of which is observed, others as missing, and you just impute zeros everywhere, the output of your model is going to be substantially skewed. It's going to be biased, and it's going to suffer from big sample selection. Whether you're dealing on just companies for which we have observed enough of the stuff, or whether you're imputing data in this way. Note that this is not just a problem for these two papers. This is actually something that has been plaguing like all of the existing literature in this area, but it's just that with a large set of data that we are now using for prediction, that we're going to be able to understand how big is this issue. And it does have very important cross-sectional implications, which is why I want to highlight it here. If you're looking at just characteristics alone, the set of 40 or 50 variables that are by now standard in this type of literature, 70% of stocks at any given point of time are going to be missing at least one of them. And this is not innocuous imputation, because we are talking not about microcaps. We're actually talking about half of the overall market capitalization. And of course, they're going to be related to companies which are going to be smaller, to companies that have less of a coverage by analysts. And these are also going to be related to a lot of the anomalies. So in other words, these are usually the companies about which we don't have a lot of data. These are the companies which are opaque. And obviously, it will have massive cross-sectional implication for the reliability of the prediction for the earnings and return forecast. This is why when we're talking about the cross-sectional patterns in the predictability and what type of biases analysts are showing towards different firms, I think that this is an issue which is intimately related to the imputation of these methods, and is also intimately related to the missing stock characteristics. So one of the questions that I was wondering while reading both papers is to which extent the results that cross-sectionally are being uncovered are actually going to be biased because of this. Now, usually forecasting is great whenever we are looking at just the overall predictability function. But it is important on how we use that predictability. And especially when we're concerned with not just one period forecast, but the term structure of forecasts. The same companies are being reviewed by different agents, and the same agent, analyst, is going to be producing forecasts for a range of companies. They're going to be producing forecasts for the earnings at different horizons at the same time. This implies that we cannot just use standalone model of forecasting for each of those models at the same time. There are important economic restrictions that are going to be imposed on the output of these forecasts. And this is why I don't think that the standard kind of IID type with a kitchen sink approach, linear regression or machine learning, is actually applicable to this type of settings. Cross-sectional and term structure restrictions, links between the forecasting functions should be part of the exercise here. They're going to make the output even better, and they're also going to help us understand the economic channels through which different predictors or different periods are going to be manifesting themselves. And this is where the role of the analyst is also going to become very kind of clear and very easy to see. And that's because a lot of the biases, a lot of the problems that are related to the role of the forecasts, professional forecasters, is something that we have already established from simple reduced form evidence. So for example, the fact that the long-term forecasts are usually too high and then they get lower down towards kind of reasonable values closer to the announcement dates is something that we knew even without machine learning. The fact that there is massive cross-sectional variation in the biases of those forecasts, they are largely for less predicted companies, when the analysts do not need to provide a buy-sell recommendation, when there are certain types of affiliation with investment banks, is also something that has been documented in the previous literature without the role of the machine learning tools. So what's really new? What are these papers bringing to the table, and where is, I think, is the main role of the machine learning here? The two things that these papers are going to be bringing to the table are first, the bias analyst channel. Even after controlling for all the public information that we see out there, firm characteristics, macro data, and all of the other things, the biased forecast of the analyst is still very important and useful for producing an unbiased and hopefully statistically optimal forecast for the earnings. That definitely beats all of our benchmarks. There could be three ways why this could be achieved. And it would be really good if in some follow-up work, there would be a more discussion of exactly which one of these channels is going to be manifesting in reality. There could be some soft information that is just not captured by this public data. It's plausible, but to be honest, I think that there is a much higher probability that it's going to be channel number 2 and channel number 3 at play. Empirically, why they should not, but data transformation does matter for machine learning. And if you find the right way to transform the data variables into kind of a better, with a higher signal to noise ratio type of forecast, and then you put it into the machine learning tool, then the forecasts are going to be much more reliable, they're going to be more stable. The forecasting, the link function, is also usually benefits a lot from imposing various economic restrictions from the machine learning output. What I think is the role of the biased forecasts, the analyst forecasts, and why they are so useful, even for predicting with the help of the machine, is because they allow you to achieve the trade-off between the bias and the variance. And because they intrinsically allow you to impose restrictions on the otherwise quite volatile and a bit ad hoc forecast that is coming directly from unrestricted machine learning tools. And there are ways in which we can try to test these hypotheses by comparing certain types of prediction outcomes. And this is where I think further analysis is going to be able to shed some light. Now, I know that I'm running out of time, right? So I'm going to skip this and let me probably finish with a conclusion. Yeah. So I really enjoyed reading these papers, and I think they provide really important contribution to this literature. And I'm not saying this lightly. There is a tremendous things that we can learn with the help of machine learning tools, and in particular the economic channels that they highlight. But going forward, the types of kind of advice that I would really, and type of development that I would really like to see in this literature is that, first of all, understanding that it's not about the point forecasts. It's about the whole inference, the whole machinery that comes along with them. And there is nothing black box that machine learning tools are bringing to the table. We should be thinking about what's the economic decision problem, how to put economic restrictions on what makes it for a good forecast, for a good decision making based on the output of those problems. And this is why standard off-the-shelf tools should probably step aside. And we should be thinking about not just mechanical forecasting with the fanciest available techniques, but we should be thinking how to model the economic decision of the agents that are standing behind those forecasts. And that's where I would like to finish. I'm sorry for running late.
Thank you very much, Svetlana. Okay, now we go to the others. Let us start with Alejandro. I want to remind everyone that the chat is open for questions. You have the floor, Alejandro.
Sorry, I have 5 minutes, right? Or...
Yes, 5 minutes.
Okay. Thank you very much, Svetlana, for the wonderful comments. I think they were very, very insightful. Let me just talk a little bit. I think I agree with most of the technical things. We were using the term statistically optimal in a little bit of a light way. At first, I wanted to put like a rational benchmark, like, this is supposed to be the best conditional, the best measure of the conditional expectation that we could have gotten. And at some point, Jules was hesitant. It's like, no, that's too much of baggage. We should just call it statistically optimal. But I definitely agree. Like, there's no like general theorems. We generally have like this anything goes. Like some estimators are better for some class of problems. And we just find that random forest gave us like a very good error term, but I'm sure other similar estimators may give us that thing. Yeah, and just to talk a little bit about the paper, I'm going to take advantage of the screen share super quickly. Hopefully everyone can see it. And just a little bit to tell you about the story of this. It actually started because I was reading a couple of behavioral literature, and then they mentioned something like, you know what, whenever we think about whether something is like sentiment or whether there's a bias, like we don't have a good measure for it, right? Because if you think about like, is the price of stocks too high right now? A lot of people would say yes, but in order to say that, you have to answer the question, what should have been the price of stocks right now? Like, what is the rational benchmark, right? And the idea here is to use the statistical benchmark as a rational benchmark. Of course, the conditional expectation using all of the information available would be the best statistical forecast by definition, but we don't have access to that, right? So, so the solution was to use machine learning to proxy for this statistical benchmark. Other than that, I was very happy with the we will definitely need to try some of the suggestions that Svetlana mentioned. I haven't checked Philippe paper yet on the random forest with linear regression, but that should be interesting to use. I just wanted to show that it is actually the case, for example, that we do find non-linearities. Like now the cool thing is that these machine learning techniques have been becoming like more and more interpretable. So we have in this picture that we're actually like using analyst forecast, of course, the interaction with many other variables, but it's also like in a smoothed way. Like once you try to understand what the what the random forest is doing with the analyst forecast, like saying, okay, you know what, it's definitely a monotonic function of this, although at some point, like analysts overreact, and then we have to smooth it out. So we do get those kind of effects. And I agree with Svetlana that, you know, so that we didn't really want to introduce any economic restrictions, because the way I see economic restrictions are like priors, right? And the priors are good if you have a good prior. And I wanted to say, like, well, what can you say about it if you literally take like the agnostic view of, you know, like this is just a statistical forecast. We're not putting like economic intuition. We're just putting like a benchmark to make it as close as possible as, you know, what a statistician with like a zero knowledge of the finance of the finance literature would do. But I really appreciate the comments. I will definitely be asking for the slides later on, and I'll be happy to try some of the stuff as Svetlana was saying. That's it for me. I also think she did a very good job of summarizing at least our paper. So I don't think I should dwell too much into it. For some reason, I cannot stop my screen sharing.
You're not sharing. It's
okay, good.
Yeah.
Well,
Okay.
it's just weird something. Perfect.
Thank you very much. Let us move to Haifeng. Yes.
Yeah, hello. Yeah, many thanks to Svetlana for the excellent discussion and also summary of the two papers. I also agree with most of the point. I think she make excellent points. So a few things that we have also been thinking about, like for example, in particular, I like the comments or suggestions that we should try to impose some economic restrictions or constraints on the machine learning output or the machine learning process. So this is something I think it'll be quite interesting, right? So currently we kind of using machine learning without any restrict constraints, and we after we get an outcome, we try to open up the black box and to see what kind of economical relationships the model captures. But it certainly will be more interesting, right, if we show that we impose certain economic restrictions based on ex-ante theory, and then that lead to even better results. Or that we can even use machine learning models, right, to test some prediction from theories, right? So that would certainly be interesting, right? But in some sense, that's also quite challenging. I also kind of will welcome more suggestions there, right? So a lot of times that in our paper, we try to compare machine learning based forecasts to quite a few earning forecast models developed in the literature. So those models developed in the extant literature, they mostly are based on economic theory. For example, Farmer French, two of the model are based on Farmer French, one of a very well-known Farmer French papers. But one problem is that, so a lot of this economic theory, in developing the theory, we try to abstract a lot of the details, right? Focus on some important kind of elements, right? But the details we abstract away actually could be very important, right? Our understanding of the world is very limited, even if our academics, right? We have very solid training, everything. So our paper, which is one of the goal actually, is we want to show that there is a limitation perhaps with the theory we have developed so far, right? So the earning prediction literature can go back to like 60s, right? Now it's more than half a century has passed, right? But it seems that those economic theory-driven model still haven't really generated any satisfactory kind of predictions, right? As one of the survey papers suggests, those existing models even kind of lead to some absurd conclusion, right? Suggesting, maybe, when it comes to forecast future earning, you don't really need to look at anything else. You just look at a historical earning, right? Which does not really make sense, right? So one of the purpose for us to show that, maybe there's some limit there, and we also show that, perhaps machine learning, it's not only just helpful to generate better forecasts, right? By opening up the machine learning, the black box, we can also learn something useful, right? For example, in our paper we find, tax expense and changing tax expense are quite important, right? Which is kind of even more important than a lot of other economic factor or predictor that literature identified, right? And then, theorists or researchers, right, can try to understand why that is the case, right? So that's something like we have been thinking. I certainly like the idea that if we can impose the economic restrictions or economic theory together with, or marry this economic theory with machine learning, and that certainly will be something fantastic to do, and we're still working on it as well, right? So the other point are also quite they're very good comments. So for example, I also like the comments that we kind of impute the missing values with either 0 or cross-sectional mean or median, right? Those may introduce bias, right? So that's something that will be interesting thing to test as well. I really like all the comments, so I don't have much many other things to add. So I will just leave the time to a question from audience. Or okay, that's all I have now. Thank you.